Well, let's move on to the next slide. And again, I'm going to leave this in your capable hands to share with the audience exactly the meaning and value behind the numbers represented here.
If you understand this slide, it's an interesting slide. You know a lot about the reverse mortgage business. On the vertical axis, we have percentage of the home's value. On the horizontal axis, we have ages from 62 up to 99. You can be over 99. There's just not that many people that make it that long. This slide tells you is that the younger you are, the less you qualify for at the start of the loan. So someone in their 60s and 70s might qualify for roughly a third of the home value. Someone in their 80s, maybe around 50%. And as you get into 90s and above, maybe as much as 60 or 65%. The reason for the 3 lines on there is just to show you different ranges if interest rates are high, middle of the road, or low. The lower the interest rate would be the top line, because an interest rate environment is lower. Clients qualify for more funds at every age respectively. When interest rates are higher, they qualify for less. Just with market, we're kind of trending near the lower line, the 7% line down there.
So the interest rates have a direct impact on how much as a percentage of the equity that we'll lend?
To a lesser extent than the age of the customer, of the youngest customer, but it is a variable in determining the loan to value ratio, the percentage that's available to you at the start of the loan. Unpack this presentation, you'll see that over time, the reverse loan amount or credit line gets to grow. So it doesn't really matter when you start, but this is just to ground our viewers, to let them know how it works up front, the amount that you qualify for at the start.
Because that's a big difference between 31% and 41%, between 5% and 7%.
100%, and it just changes with the market and Fed involvement, or the FHA involvement.